Welcome to the October 2021 monthly market report. We're so happy to have you here to learn about the latest happenings in the real estate market. My name is Rory Osorio with Douglas Elliman Real Estate of Rory's Open Houses. And over the next 20 minutes or so, I'm going to be walking you through everything you need to know this month about the housing market. So I'm going to start today with an update on pricing, and I want to begin with this quote from Bill McBride from Calculated Risk. It says, "My sense is the Case-Shiller National Annual Growth Rate of 19.7% is probably close to a peak, and year-over-year price increases will slow later this year." So what does that mean? As you're out there seeing things like prices have peaked, prices increases will slow later this year, it sparks question and uncertainty. And what I'm going to bring for you today is some context and clarity on what's happening with prices and what to expect moving forward. So let's start with a look at July 2021 year-over-year home price appreciation. This is the latest data we have. And the Federal Housing Finance Agency House Price Index showed 19.2% growth. CoreLogic is showing year-over-year appreciation at 18%. And the S&P Case-Shiller Index is showing 19.7%. So this is dramatic. This is incredible home price appreciation. And as we look at this, it's largely due, as we have been saying for months now, to supply and demand. We simply have not had enough homes on the market for the demand from buyers, and that causes prices to rise. Simple conversation there. So let's take a look at the macro, what looks across the country. This is our price appreciation map year over year for the second quarter of 2021. Now, what you can see here is that the states in the red have over 20% appreciation over the past year. As a whole, 17.4% for the United States. But you can really see how it breaks down state by state here. Now, what we're starting to see is the forecast for going forward and what experts are projecting going forward. And that's where I want to really clarify this conversation. All right? And I'm going to start with this quote from Iva Zellman. It says, "Closings are set to decline roughly 10% year over year in the second half of 2021, right now. And home price appreciation is on the cusp of flipping to a decelerating trend." So what does that mean? I want to hang on that word decelerating for a moment because that's where we really need to provide clarity. When consumers see the word decelerating, they immediately go to think depreciation. But hear me loud and clear when I say that experts are not projecting depreciation. What experts are projecting is increased home price appreciation, just at a slower or more moderate rate. So that's where decelerating comes into the conversation. And it's really mission critical to understand the difference between depreciation and a decelerating or decelerating trend. So let me show you what that means. This is the estimated home price performance, and it's from the Home Price Expectation Survey. What we can see right here is that through the rest of 2021, home prices are expected to continue to increase at about 11.74%. So that means continued appreciation. Simple there. And what we also see is that not as massive as we've seen over the past year with that 18 or 19, almost 20% appreciation, bottom line. So a more moderate pace through the rest of the year. And going forward, we look at 2022, 2023, and beyond, we're seeing continued appreciation, but again, at the more moderate pace. 5.82% for 2022 and so forth. That's the pace. So what that means is that home prices are not expected to decline. They're just expected to appreciate at a slower pace. And if I can't totally drive that thing home, let's go break it down a little bit further. This is the expected home value change. And this also comes from the Home Price Expectation Survey. So what you saw, that 11.74 appreciation for 2021. And if we average out the 5 years that I just showed you on the previous slide, the annual average through 2025 is going to be 5.7%. Now we know that historical norm for home price appreciation has been about 3.8% per year. But that historical norm has even bumped to 4.1% due to the price appreciation over the past year. So even the historical norm is climbing. And then cumulatively through 2025, home prices are expected to appreciate a 31.8% if we add up the next 5 years. So look, So home prices are still definitely rising, again, due to supply and demand, and not expected to decline. And so what's really important is that we help buyers and sellers for that matter, to understand that, and to really understand that selling is right now. It could occur later on next year. Is it going to appreciate any faster? No, that means property is probably going to stay on the market longer. Okay, not as quickly as they moved this year, again, because of the quicker pace at which it appreciated. But buyers in particular, okay, they need to get out there and buy these properties before these home prices continue to accelerate, and that's really important. So look, getting in, well, while the mortgage rates are still low, that's the big thing. Boy, I get so excited, I'm talking too fast. We know that mortgage rates are ticking up. That's a given. We know that home prices are expected to continue to rise. So if buying now, if you can find a home, is really mission critical to that long-term wealth advantage. Sellers, the same thing. And we always say, if you could go back 10 years and do it again, would you buy another home? Because the value has increased exponentially. And most people would say, yeah, I'd buy a home. I'd probably buy 2 or 3. So that's really the message we really want to be sharing here, is that home prices are not expected to depreciate. They're just going to be appreciating at a decelerating pace. Can I totally kill this thing? No. So right now, what we need to get into right now is the big question is, what about the fourth quarter? How is this year going to end up? And normally, about this time, we would be bringing on the monthly market report, your forecast, and things looking forward to the fourth quarter. And but it's sort of hard right now for forecasters to go out and make any type of assumptions on what's going to happen because of the last year and a half into the pandemic and how unusual that's been. So for the next couple of minutes, I'm going to try to explain the position the forecasters are in and show you really what we need to be looking at. And then we're going to wrap up and talk about interest rates, probably one of the biggest issues right now that people are looking at, which is the rising of interest rates. And we'll give you all that information momentarily. So let's start off here with Diana Olick from CNBC. She says, fall is usually the start of the slower season for the housing market, but nothing is usual in today's pandemic-driven housing market. Potential homebuyers are seeing a slight rise in inventory and consequently rushing back into the fray. I don't know what they're rushing back into the fray for, but certainly people are noticing that. Mortgage applications to purchase a home jumped 7% last week from the previous week, and that is the highest level since April of this year. So people are saying, hey, we want to get back in. We're seeing rise in inventory levels, but yet forecasters are struggling with how do we forecast the remainder of this year, okay? And the bottom line is home sales are very difficult to forecast right now because of these 3 lines. What is this? It is annualized home sales from 2019, 2020, and the green line, 2021, okay? Just look at this, 2019, 2020, 2021. Now, what you see here is the obvious. 2020 was nothing like a normal year, which we saw in 2019. So if we want to go back to a normal year, we have to go back to 2019 and look and say, what did that look like? Because we know what the pandemic brought. It brought this orange line here on the screen, the dip down, the rise back up, and we sort of did a double duty in the second half of last year when we packed all of that business into a short amount of time after the lockdown. Many people, and this started because, many people were looking at it because of the slowing of the low interest rates, because the needs of home changing, because all the things that we talked about on the monthly report rushed back into the market, and it became this total abnormal year. We sold more homes last year than we sold before. And we know the story of that. So let me break it down as to why it seems like things are slowing down. That's really what we're going to talk about again, because the whole point of this is the deceleration versus depreciation. Why it seems that our things are slowing down. And this is probably the best visual I can give you of why that seems that way. Remember, the front half of the year we talked about all the things that we were going to see, from inventory to annualized home sales to so many things that were going to be up year over year because we were in a lockdown. Now, a lot of people took their homes off the market, the business slowed, the economy slowed back into the spring of 2020, and then this year, the spring of 2021, we were over that, but simply because things were in lockdown. Well, we're about to enter a time in the latter half of the reporting season, the end of summer into fall and winter, where we packed a ton of business and we're going to be below that orange line, and folks are going to say, hey, we're down year over year, and you're already seeing that happen. You're down in home sales and foreclosures are rising. Now, we talked about that issue extensively here, but just realize that's the kind of situation we're heading into. But the reality isn't we're beating 2019, which was a very, very good year in real estate, but the last normal year that we can look at, and you see right here when I've isolated 2019 and 2021 here on the screen, you can see right where we're at. And so the reality is we saw 2019 being one of the best years in the last 10 years in real estate, and we're ahead of that right now. See, we're ahead of that on the upward section right here. Okay? So we're still seeing 2019 being a good year. Now, this is a look at existing home sales going all the way back to 2012, and you can see it right there. 2019 is the best year. Yes, 2018, my face is covering 2019. The best year except for 2017. Look, 5,530,000, 5,560,000. Yeah, it's a little bit of, but we're doing very, very good. That's to make the point of 2019. See that right across? Still being very good. So if I take things back to where we were just a moment ago, home sales were very, very difficult to forecast because forecasters don't know what's going to happen for us right here. Because of this abnormal 2020, we don't see what's going to happen. But we have some options to think about, okay? And here's what those options are going to look like momentarily. And again, we're going to go back to this what people are kind of saying out there on the street. Well, if we see 2020, then we're either going down or going to go up, or what's going to happen. Remember, this orange line right here was based on the pandemic. And so everybody blocked in into here, all that activity. But we're not seeing that. We're already post-pandemic. So where's this green line going to go? Okay. If it follows 2019, that's what we're going to see. This is what we're going to see. So what does that look like? Okay. For that, we have to look at what we call active listings. And this is a look at what active monthly listing counts for 2017, 2018, and 2019. And again, we're trying to get context and perspective. Remember I said 2019 was the last normal year we saw, so we're going back 3 years. And what typically happens in our business is listing peaks sometimes in the fall, then drops off, and we repeat the cycle again. So you can see here for the last 3 years before we got into the pandemic, 2017, 2019, listings peaking in the fall and then dropping off before starting over a new year. And then we know after 2019 brought 2020. Ooh, 2020. Let's see where that goes there. Here's 2020. Here is our peak, our active peak right here in April. And then, did I just whistle? I just whistled, yes. We start this going down. So again, how are we going to predict that? How are we going to move forward into that fray and see how the market's going to either dwindle or, again, are they going to rush back into the market? So this sets up the challenge moving forward is really about how do we close the gap? As those listings dropped, sales shot up, okay? Sales dropped. Remember, so if listings are going down, sales are going to shoot up. Okay, see right here? Inventory dropped. We saw sales going. Listings last half of 2020 went down. We saw up. That's closing the gap. I hope I'm making sense on that. Forgive me. Now, the big question becomes now, when will listings peak this year? And so, if we saw listings drop last year, we troughed out here in the front part of the year, less listings on the market than we've ever seen. The question is now, when will they peak? And there are 3 scenarios, okay? One is that they're going to continue to grow, okay? And we're going to eclipse where we went in 2020, and that's going to give us a little bit of relief in the frenzy in the market and pricing relief, okay? More inventory, pricing relief. Simple. More inventory, pricing relief. There's a second option that just flattens out, and we continue on there and probably intersect where we were in 2020 at some point. And then there's the third option, where listings peak and begin to dwindle. If the third option happens, that's where you see more price appreciation. It's upward pressure on prices, and that will be the story. But I think there are three reasons why we will see continued listings going into this fall. Three reasons listings may continue to increase throughout this fall into the winter. First of all, pent-up seller demand. No doubt homeowners are going to be more comfortable putting their homes on the market as more people get vaccinated and the world gets normal. They feel comfortable from a health perspective doing so. Number two, new construction is starting to take off. Builders are realizing the opportunity, trying to build as much as they can. Now, this past year, they've had a lot of headwinds in front of them with material costs, specifically lumber, all the things they need to build a home outside of lumber, all the labor costs and labor shortages have been a huge headwind for builders. But they're starting to turn the corner and build and see the opportunity in this market. And three, the end of forbearance will create new listings. Now, we've gone over this extensively on the monthly market report, so I'm not going to create too much of an issue. But the bottom line is, it's not going to create a wave of foreclosures, but it will create a time in the market for people to say, you know what, we can't afford the home any longer. We're just going to take our money and run, put the house on the market. So I think there's a lot of reasons right now that we'll see listing numbers begin to or continue to climb. But at the end of the day, we're going to have to watch it if we really want to know what's going to happen. And the question is what the market is going to do. We have to watch listings. That's all we got to do is just watch listings. And we have to be diligent about getting out there and obtaining those listings for that matter. And you know what? I've talked all the time about what we started off here is the pricing by product has increased in equity in so many people's homes. Okay. And they're saying, you know what? We may take advantage of that equity and move up and downsize, whatever the case may be for that family. And that's really a situation here that is relative to forecasting the fourth quarter and going into next year is all about listings. So once again, you almost have to look at yourself as both a homeowner and a buyer. If you intend to sell, or home seller and a buyer, if you intend to sell the property right now, understand that you're also going up against appreciation of those other properties that you intend to purchase. You are going to go against that. Now, is it going to be as dramatic as it was in 2021? No. Or 2020? No. It's going to be at a slower pace. So you're going to have enough time to think about and assess what the valuation that you can get your property to, but it's going to be slower appreciation, and the buyers are going to be able to buy and whatnot. But you're going to be that buyer that needs to go buy that property today also. Okay, so it's a good balance to have. Now, the other big story now is interest rates. No doubt we're starting to see some movement in interest rates for a lot of different reasons. But I want to talk about that for just a minute. And certainly not here today to say the sky is falling and interest rates are about to shoot up. I want to give you a look at what interest rates are doing so that you can pretty much be educated on this topic. Okay? First, a quote from Ali Wolf. The single biggest risk to housing is rising mortgage rates. It's a real possibility the next year, and it could bring prices down. Further, other economic, financial, and confidence challenges could also result in a drop or flattening of home prices, even with solid buyers in place. But a drop, a flattening in home prices is a far cry from the crash we saw during the Great Recession. So I can stop reading. So Ali Wolf saying, you know what? The biggest issue, the frenzy in the housing market could be rising interest rates. It's going to be more expensive for people to borrow, okay? Right now, the 30-year fix just jumped above 3%. Sort of crazy that we're talking about a rising interest rate environment, and we've had an average 30-year fix of just over 3%. You see right here, 3.01% is recorded by Freddie Mac on their weekly survey. And that jumped up as they're starting to see indications of the Fed saying, listen to this one, we're going to taper soon. The word they've used is right now, okay? Right now. Let's talk about what that tapering means. Sam Catter from Freddie Mac says this: many factors led to this increase, including the Federal Reserve communicating that it will taper its support to the capital markets. Time out there. That's the soon element. The Fed came out and said, you know, we've been buying mortgage-backed securities. Now we're going to start to taper that. We're going to start to pull back on that, and we'll do that coming up the market, and we'll do that so as the market comes up, starting to price that in. He goes on to say, the broadening of inflation and emerging energy supply shortages, which compound other material and labor shortages, so that the issue right here is that the economy is recovering. Not recovering as quickly as they would like to see, but the Fed saying, hey, we're going to start to taper on what we're buying in the mortgage market. So that's causing interest rates to go up. Now, I think it's important that we realize we're in a great environment right now. It will cost more to buy as homes appreciate going into the next year, as interest rates are going to go up into the next year, but nobody's calling for this sharp spike in rates yet. As a matter of fact, here are the latest projections and interest rates from Fannie, Freddie, and NAR. And you can see somewhat around the middle to the third quarter of next year being about 3.5%. Okay? So we're just right about 3% right now. If we want a visual for this, here's where they're going, according to Freddie Mac. Okay? But at the end of the day, are we going to probably see 4s? I don't think so. We're going to see probably 3.5, but the rates are still going to go up. That's just a given. Now, what is the cost of waiting? Okay, what is the cost of waiting? And this is a real simple thing. I mean, at the end of the day, if a $400,000 home loan amount at 2.75 was at 1.633, you know, you go up here at 3% and you're at 1.686. The reality is if we go to the 3.5, now what we're seeing, okay, 1.633, is that rate of 4% is going to now afford us only a loan amount of 340. See that? So this is how you read that chart basically, is if rates go up, you're affording less of a loan. Less of a loan, less of a sales price. More down payment. Kind of simple right there. That's the cost of waiting. Now, DS News came out with this quote, and I thought it was very, very good. Homeownership is one of the fundamental key to accumulating wealth in America. Hence why it's been integrally linked to achieving the American dream. Not only can owning a home provide a roof over your head and a secure place to live, but because mortgage payments generally remain fixed while rents may rise over time, a home can be a very effective hedge against inflation. Listen to that. Inflation is being talked a lot about right now. A home is a very effective hedge against inflation because you have a fixed payment. It goes on to say, together these features can give homeowners an enormous advantage over renters when it comes to accumulating wealth. The opportunity for homeownership not only is a shelter, we know that the financial, non-financial benefits of homeownership, but it helps people build wealth, no doubt at all, across the country. The question right now is, with rising interest rates, prices going up, many people are saying, you know what? I don't want to buy right now because I don't want to buy at the top of the market. Well, I have this conversation like you do with friends, and you're certainly having it with clients more and more these days. But what people fail to miss in that is forecasters are not calling for depreciation in the market. I think there may be some deceleration of prices, meaning we're not going to stay at a price point at the appreciation point that we've been at, and we're going to see less appreciation, but not depreciation. Okay, so we really are. When we say we've already peaked to a certain degree. But the key is this: with those rates being where they're at, you need to be buying. Plain and simple, because you're going to hedge yourself with that fixed payment against that inflation. Look, the home price expectations survey came out, and if you look at a $350,000 home over the next 5 years, the purchaser of that home stands to gain just over $111,000 in gained equity based on forecast appreciation over the next 5 years. And when people see this, they're thinking, why would I buy at the top of the market? They're still missing this piece, and they go, wow. But right now, the bottom line is homes across this country are underbuilt. We've talked about that, undersupplied, and that's not going to be fixed overnight. So I hope all of this information finds you well, okay? Here's the reality of what's going to happen. Short of anything else, But the rapture, I don't know what to tell you. Here's where we're at. So folks, I'm going to leave you with this. Here's the other resource, and you'll pick up this. You can, there'll be a link below to get the full report and everything like that. But the bottom line is this, folks. If you're a seller, you really need to think about, because you're going to be a buyer, you really need to think about the fact that we've pretty much peaked in how quickly we can appreciate. Not that appreciation is not going to continue to occur, but it's going to continue to occur at a slower pace. What does that make you as a buyer? As a buyer, what's going to happen is you need to buy now. Sell now, buy now. Buy now, why? Take advantage of the low interest rates, still be able to afford up to that point without the rates going up to 3.5 or 3.875 or 4%. So it's finding that balance between you and your agent, myself included. Just find that balance of, where do I want to go next? What's that going to cost to go next? And can I pull it off with what I can sell right now and not get too greedy and wait for up here when everything else is also going up here? I hope I got that point across. Once again, folks, thank you so much for being here. All I ask you right now, if this information was of value to you, do the emojis down at the bottom. Thumbs up, thumbs down, smiley face, clappy face, or any emoji you want to. I'd really like to hear your feedback. If you have any questions about your particular property, please, down below, schedule an appointment with me, 15, 20 minutes. We can talk about it. You want to micro into your regular communities. There's also down there some links to that. And I leave you with this. Put love in front of everything you do and you'll never work a day in your life. Think I'm working? No, I love what I do. I love providing this data. I love helping people go from point A to point B, whether you're a first-time buyer, move up, downsize, or that sunset buyer, seller, whatnot, who's sitting there just watching the sunset. I love those phases. I've gone through all of them to some degree or another. All right, guys, take care, y'all. God bless you. Have a good day. Take care.